This is an additional activity on partnership ledger accounts. Right, the first question here asks you to draw up the current account of IMP and to balance the account at the end of the month, and then they do tell you that no dates or folios are required. Right, the first thing they tell you here is at the start of the year, the balance of IMP's current account was 7,200 and his earnings exceeded his drawings. In other words, there's a positive balance here. Money is owed to him, so that balance goes on the credit side. Right, then the summary of IMP's earnings, he earns a salary, 17,000 Rand per month. We need to show what he earned for the entire year. So for the salary of IMP, we're going to multiply that 17,000 by 12 to get 204,000. His interest on capital is 15,900. That increases his earnings. Then there was a share of a remaining loss. If there was a remaining loss, this must go on the minus side of his current account, as it decreases what he's entitled to. So that came from the appropriation account, and the amount they gave you was 11,150. They then tell you that the balance carried down was on the debit side of his current account. So in other words, this final balance here would be on the credit side, and then, debit side, and then get brought down to the credit side. And then they tell you you must calculate his drawings. In other words, this figure over here. To do that, you simply work out the difference. So you add up the credit side, the difference between that credit side and the debit side. So you would take that credit total of 227,100, subtract the 11,150, as well as subtract the 14,550, and that would give you the drawings figure of 214,500. The next question is some true and false. Partners have limited liability for business debts. That is false. It's one of the big disadvantages of partnerships, and that is that a partner's personal assets can be used to pay the debts of a business. Partners always share profits in the ratio of their capital balances. That is also false. They're shared according to whatever they've written down in the partnership agreement. So whatever they've decided on in that agreement is how they share the remaining profits. The closing transfer entry for remaining loss will appear on the credit side of the appropriation account. That is true, okay, because to close off appropriation, if you're crediting it, it means your expense side was higher than your income side. And then a partner's capital contribution must be in the form of cash. That is false. It could be in the form of an asset. It could even be in the form of a special skill that a particular partner might have. So they could put a monetary value on that skill, and that could be his capital. And then a partnership lacks continuity is true. If a partner leaves the partnership, dies, retires, whatever, a whole new agreement needs to be drawn up. So the partnership is therefore going to lack any form of continuity. Right, then for question 4, they give you a ledger account as well as some additional information and ask you some questions. Right, the first thing they ask you is to calculate the monthly salary that Tail would have earned in January. And if you read here, this third bullet, Tail's salary for the year was 124,000, and both salary partners had increased their salaries on the 1st of January by 2,000 Rand. This is almost like a rent adjustment, but we're using it to do with salary. So the first thing you do is you count the number of months. So from the start of the year up to the end of December will be 10 months of X, and then the last 2 months will be X plus 2,000, and then that must equal the 124,000. So therefore, you work out, or you solve for X, you get X as 10,000, and the one for January will be 2,000 more than that, so you will add 2,000 Rand on and get 12,000. Then complete the table for each of the following transactions. He took his monthly salary for January and in addition trading stock which had cost 4,100. The markup used is 50% on cost. So when he takes his monthly salary, everything the partner takes goes to the partner's drawings account. So because he's taking money, bank will be credited, drawings will be debited. Because a partner is taking stock at a marked up price of 50%, you're going to make profits. So you debit the partner's drawings and credit your sales with the selling price, and then cost of sales is debited, and trading stock, your asset is decreasing, is credited, and that will be with the 4,100. Then the adjustment entry for salary, that's the first time you bring salary into account, so you debit salary and credit the current account as part of his earnings. And then to close off with the annual salary, that's where you make debit and credit side equal. So you credit the salary and it goes to the appropriation account. Right, then they ask you to calculate the interest on capital amount for tail, which is amount marked A here. So this one here. So they tell you that tail's capital balance at the end of the year was 201,600, and it increases capital by 12% on the 1st of December, and the interest rate is 9% per annum. Okay, so you're going to take the salary, sorry, not the salary, the capital figure. That is 112% of what it was before the increase. So if you divide by 1.12, you get the original capital of 180,000. The 180,000 he had for the whole year, so you just times that by 9%. And then the increase, the difference here of 21,600 at 9%, he had for 3 months of the year, December, January, and February. Add those up and you get 16,686. What you could have done is 180,000 for 9 months and 201,600 for the last 3 months of the year. But both of those will give you the same answer as the one I did. Right, then partners share remaining profit or loss in the ratio of 3:2, which is tails to spin. Calculate the remaining profit made by the business. So you have a look here. The partner here, there was a remaining profit here of 22875, and he got 3/5. So you're going to divide by 3, and you're going to multiply by 5 to get for the full business, and that gives me 38125. Then Taylor's unhappy about the profit sharing ratio. Why would this be the case? If you have a look here, they told you over here that Spin's capital is half that of Tails. So Tails put in double the amount of capital, yet he's only getting 3/5 of the amount of the profit. So that is why he would be unhappy with that. Then partner Spin's in charge of the stock records as well as all payments made to suppliers for stock purchase, as well as supervising the stock when it's delivered. At the end of the financial year, there's a large deficit amount, and Tail has queried this. If you were Tail, why would you be concerned? Okay, there's various reasons here. Stock could have been stolen. If you've got a deficit, your net profit will go down, so his share of profit will decrease as well. The partner could be buying stock for himself using business money, in other words, committing fraud. So basically, you can't have the one person in charge of everything. So 2 internal control measures that could be implemented to prevent a similar incident from taking place. You could have division of duties. One person orders the stock, the next receives the stock when it's delivered, the third records the stock in the journals, and so on. And the other thing you could do is you could make sure that all orders are properly authorized and signed and countersigned by the relevant people to prevent the one partner from ordering stock for himself using business money. And then Tail and Spin have unlimited liability for business debts. What does this imply? It means their personal assets can be used to repay business debts in the event of insolvency. So their personal assets are not protected. If the business is declared insolvent, they're going to lose their own assets. Right, that's it for now. Thank you.